Good afternoon. This is Tommy Ruke with the fourth section of our business auto coverage form review. If you have any questions during this presentation, please type them in the chat window. They will be answered as time allows here or later respond to you with a email, and if it's appropriate, share your questions with all the other participants in this presentation so that they can learn from your questions. If you have any problems with the audio and or the presentation, please type in the chat window and or call our office 800-741-4084. Again, 800-741-4084. We'll attempt to correct these problems as soon as possible. Let's review. The first hour, section 1, we talked about how to set the policy up. We discussed how to make sure that you is the operating entity we are dealing with, and we would also talk about what is a covered auto, which would have to be involved in the accident that would cause the policy to respond. You is the legal entity on item 1 of the deck sheet. It should only be the operating entity. There's no need to list the owners of legal entities on the deck sheet. And if the insured is a proprietorship, an individual, this causes more problems because of possibly bringing in personal exposures onto the commercial policy. As a matter of discussion, we talked about this is a commercial policy. Therefore, we do not want to pick up any personal use of vehicles on the commercial policy. This does not, in the long term, provide a benefit to the insured, because if an accident happens, then that loss on that accident that was caused by a vehicle being used personally would be charged against the commercial auto coverages, and that would cause, in all likelihood, an increased premium for a number of years, costing the business more money. So we talked about leaving the personal exposures off of the commercial policy. What's a covered auto? Clearly, any is the best. That is often found for the general use of the business auto policy, not normally in the larger vehicle commercial arena, particularly for hire. Specified would be the other option. If it's specified, then it must be listed on the policy, or there's no coverage caused by that vehicle, unless it is a newly acquired temporary substitute, or if you have hired not on coverage, hired or not on. If you don't set the symbols up properly and have the named insured addressed properly, the policy will not respond. Section 2, we went into liability coverage. The liability coverage provided both direct damage, bodily injury, property damage, and pollution cost of pollution cleanup. Covered pollution costs or cleanup addresses the pollution. What we learned was that in the standard ISO policies, there is no coverage for pollution, either the bodily injury, property damage, which we call direct damage, or the cost of cleanup. Covered pollution costs are expense if the pollutant was caused by the cargo. Now, in dealing with tractor trailers, we're talking about the cargo and the tractor. But even for the non-tractor trailer, non-18 units, it would be the 55-gallon drum of oil in the back of the pickup truck, or in the farmer situation, the herbicides or pesticides that are hauled in their pickup truck or their straight truck to the field, or fertilizer. If any of those escapes from the vehicle itself, then there is no coverage. There is some buyback, and that is the endorsement C9948, which is the pollution buyback, that does buy back coverage afforded in the policy for pollution losses caused by cargo. Without that, there is no coverage. Then we reviewed who is an insured. Who is insured? The you. Any legal entities listed in item 1 of the deck will be insured, but only for a covered auto. That's why setting the policy up becomes so important. Second, who qualifies as insured is any permissive user. Any other who operates a commercial auto that is a covered auto with the permission of the you, the insured, will be covered on the policy, whether it's a driver, employee, independent contractor, anybody. The customer is also an insured, as well as the owner of the legal entity. There's no need to list the owners of the business on the named insured line, And also the customers are already covered because of the vicarious wording in the policy that states anyone liable for the conduct of insured above, meaning the you or the permissive user is insured on the policy, but only for the liability arising out of the actions of the insured. This is blanket additional insured. So we also talked about the need to add coverage on the policy for the owners of the vehicles. CA 2048 is a designated insured endorsement which provides no coverage to the customer that we list here. All it does is clear up the question, is that customer and anyone, because anyone's already covered. That just mirrors the coverage already in the policy, basically to keep the customers of your insurance happy to see their name on an endorsement. CA 9947 is employee as lessor. This would be where the vehicle is owned by the employee personally, mainly the officer or the owner or the director of the insured. I would only want to have the people who write us a check involved in this, but they own it personally. It could be for tax reasons. It could be, used to be a proprietorship, but now it's a corporation. The insured would be covered, meaning the corporation, the partnership, the LLC, but the owner of the vehicle who happens to own the partnership, LLC, or corporation would not be. So you need to add CA 9947 to cover the owner of the vehicle for the liability for owning the vehicle. CA 201 is the additional insured lessor and loss payee. This is for the finance companies. This is when your insured has a finance lease where they lease the vehicle from the leasing company, and the leasing company under contract requires them to not only provide coverage for that vehicle but also to add them as additional insured and to send them cancellations. This endorsement should be used where there is a finance lease where the leaseor, the owner of the vehicle, is asked or is requiring the lessee, your insured, to protect them while your insured, the lessee, uses the vehicle. Notes on this one, though, there is a notice of cancellation requirement, but the rest of them are not. 9916 is hired cars specified as owned autos. This is if you schedule vehicles on the policy that are not owned by the corporate officer or employee or not leased from a leasing company, that you can add that vehicle, and again, that endorsement provides coverage for the owner of that vehicle. CA 9933 is employee as insured. This does not give primary coverage. This is when you have non-owned coverage in your policy. An accident happens because one of your employees is using their personal vehicles on behalf of the business. Could be the mechanic doing work on a truck with their own truck. It could be a receptionist or secretary going down and picking up the mail, or a sales rep. If the vehicle is involved in an accident that's owned by the employee, driven by the employee for business purposes, the insured, your insured, and that employee will be named in the suit. When that happens, if your insured has non-owned auto coverage, which would be symbol 9 added to the specified or owned or any auto, then the policy will respond, but it will respond in excess to the policy on the vehicle itself. The personal vehicle policy covering the vehicle of your employees would respond first. Then if you add 9933, that will protect the employee in excess of their own policy. Section 3, protection for your insured. Protection for your insured arising out of their auto exposure is addressed by the use of the auto coverage form. The auto liability policy will respond if the policy applies. If not, then it would be excluded. So we talked about the exclusion. In the exclusion, we talk about things that should not be covered, like expected injuries, pollution, war, or the vehicle being used in organized racing. We then talked about some definition of coverage, and that is we exclude contractual except for insured contracts. An insured contract definition includes broad form contractual. We suggest that the insured buy another policy to cover the work comp, the injuries to the employee or fellow employee is covered by work comp. Property in your insured's care, custom, control is covered by a cargo policy. So the auto liability policy excludes injuries to employees and damage to property in your insurer's care, custom, control. And lastly, the coordination between the general liability policy and the auto liability policy. These are the two liability policies of the marketplace, and the auto liability and general liability mirror each other. In the general liability, under the definition of loading and unloading, and in the auto liability with exclusions 7, 8, 9, and 10. And basically what that says is before the move starts, meaning that your insured touches the property to be moved to their vehicle, GL provides coverage if that property does damage. Once the property is starting to be moved to the vehicle, during transportation and until it gets to its final destination, then that will be an auto exposure if something happens. For example, if taking the item to the vehicle, your insured drops it and lands on somebody, or they're unloading it by a hand truck, loading it with a hand truck and runs over somebody with that hand truck, non-motorized, say somebody's foot, that would be covered under the auto liability policy. It will be covered under a liability policy during transportation and until it gets to its final destination. Then it becomes GL. Example here is one of the cases we had with a beer company unloading their beer with a hand truck into a supermarket and going back to set it into a display area. They ran over one of the customers of the supermarket's foot, and that was an auto claim, even though the truck was 100 yards away from where the actual damage was done. Once they made the display, though, and the display would fall down, then that would become GL. Very important to understand when one stops and one starts, and extremely important to have the auto and GL with the same carrier. If the auto is unloaded by hand, a hand truck, which is a wheelbarrow, a non-palletized pallet jack, or the hand truck you see on the front of the trucks, then it is auto. However, if it's loaded and unloaded by something not attached to the vehicle, meaning a power crane, a forklift, or a front-end loader, even if the forklift was brought to the job site on the truck, once it's taken off the truck to be used for loading and unloading, then that falls under the general liability policy. We're going to move now to the fourth section, and this is the physical damage and also some endorsements. Physical damage coverage. The policy wording says we'll pay for loss to a covered auto or its equipment. Notice it says or its equipment. There's no requirement for the equipment to be permanently attached or even attached. We'll talk more about that. Then we choose three causes of losses. Comprehensive. Comprehensive causes all causes of losses except for collision or upset. Or we can have specified cause of loss, where that we have to name the cause of loss that caused it, and that would be up to the 6th. And then either to specified, we can add what was not covered, under comprehensive, we can add what was not covered in comprehensive by adding comp and collision to the desired cause of losses. Or if we have specified, we can add the second cause of loss, or the 7th cause of loss, which would be collision or turnover. So we choose those. The big difference is that comprehensive, the policy will pay the damage to auto equipment, cab, chassis, and equipment if damage is done by a selected cause of loss. Any auto and equipment of the auto. There's no need for the equipment to be attached. If the equipment is the equipment of the covered auto, then it's covered. For example, I use, and being from Florida, it's hard to realize this, but sometimes a year we have snow. We have vehicles with a snow plow in the front of that vehicle. But during the summer, during the non-snow year part of the year, then that vehicle is still on the highway, probably used for other purposes, but the snow plow's in the barn or in a storage area. If that snow plow gets stolen out of the storage area, it's still covered under the auto physical damage coverage because it's the equipment of that auto. I had a case where the adjuster did not understand this. One of my clients had equipment stolen, and the equipment had a toolbox or toolbox with a lift hoist to lift tires from the ground to their vehicle. The offer of the adjuster was just for the cab and chassis. The policy, though, covered not only the cab and chassis, but the tool equipment, a toolbox that was added, and the hoist that was added. The adjuster did not understand that part of it. So it covers auto and equipment, and it does not have to be attached or permanently attached to the standard ISO coverage. Comprehensive is all risks. The closer we can get to property covered all risk. It covers everything except collision with a vehicle or upturn or turnover of a vehicle. So that is, we can buy what is excluded here, but also covering collision coverage. This then adds to the loss that's excluded under comprehensive. Therefore, we cover everything that would be happening to the vehicle that's not excluded. It will be up then to the adjuster to say, whoa, time out. This is not covered. So comprehensive has the concept of all risk, which says that everything's covered if not excluded. And then we can add collision to that that buys that back. If you specify cause of loss for people with a property background, this is what's called the name cause of loss in the property coverage. There the insured has to point out what is the cause of loss that caused the vehicle or caused the damage to the vehicle. If they could not discuss or point out something that caused it, like a fire, lightning, vehicle got stolen, involved in a windstorm, or a flood, then there is no coverage. So the difference is, basically start with is the obligation of the insured. Comprehensive collision, all the insured has to say is something happened to our vehicle. If you have specified cause of loss in collision, the insured must say this happened to our vehicle, therefore we got coverage. It's the difference in the concept of one to the other. So that's important to understand the concept differences. Also, the theory when we've gone through insurance classes that there's no such thing as all risk coverage. The coverage you find on the commercial auto physical damage coverage provides the broadest coverage possible to all risk. We've had a couple examples later that came up that I'd like to share with you. I had a discussion a number of weeks ago with a situation where we had a cabin chassis that had a crane attached to it. This cabin chassis is used to unload other pieces of equipment. It is a auto because if you remember from the other sections, it's licensed for the road, so it's auto. And so what we have is a cabin chassis that's a tandem axle rig with a flatbed and a crane now attached to it. So the question is, a discussion we had was, well, should you insure the crane? Should you insure that with inland marine coverages and then have the cabin chassis cover an auto? What I discussed with the individual I was talking to about this is that's not a good idea because both forms cover both of those items. The auto form clearly says we cover the cabin chassis and the equipment. Clearly that crane attached to that cabin chassis is the equipment of that auto. So therefore our policy would respond to cover not only damage to the cabin chassis but damage to the crane. Whereas the marine policy probably says the same thing. We cover the equipment. The equipment is not just the crane because it has to be motorized. So therefore the inland marine policy would respond to both. It's my suggestion that you do not split coverage. One form should cover both cabin chassis and equipment, not separate the two. One of the reasons I say that is if you try to separate the two, a significant part of the cost of those items are the shared equipment or the shared service items like the electrical, hydraulic outlet, the actual cost to put the units or put the items together on the cabin chassis. And lastly, when a loss happens, you not only have two adjusters, but you have two deductibles and could have two causes of losses. So you want to cover all the equipment under one form or the other. It doesn't make easy claim settlement if you split the equipment. Now, in that discussion, it came up which is the best coverage, either inland marine and or auto. And they came back and said, and my conclusion was, or my discussion ended with, auto is the broadest coverage you can provide. It is close to all risk. Whereas if you put inland marine has typical exclusions like employees dishonesty, like overload for hydraulic systems, and other items that you do not find in the commercial auto physical damage coverage. So when you set it up, be careful. We're covering the auto as well as all of its equipment. The only time when we have a loss that we have to do is verify it was the equipment of the auto. Second, most of our marketplace today provides comprehensive collision. Rarely have I seen special cause of loss and collision. It would only be for older units and units that the companies are not comfortable with, which I understand that underwriting consideration. But comprehensive collision is close to all risk. It will cover everything that happens to it except a few exclusions. We're going to cause of loss exclusions that we'll be looking at here in a few minutes. There are a couple other coverage extensions here. Towing, and you can list the towing limit on the deck sheet. But the thing that we don't look at here is in the towing provision is for private passenger type only. So again, this is a commercial business auto policy. Therefore, I would expect few private passenger vehicles that would be a part of this coverage form. So I don't consider the towing in this instance to be that important or that relevant on the commercial auto policies, that the business auto policies that we're discussing here. This next possible coverage is glass breakage, hitting a bird or animal, or falling object or emission. It says if you carry comprehensive collision in the cover form, we'll pay for loss of the falling under comprehensive. Glass breakage, loss caused by hitting a bird or animal, and loss caused by falling objects or emission, missiles. However, you have the option to have glass breakage caused by a covered auto collision, or overturn consider a loss under collision coverage. Here is the difference in this coverage. Question if the reason that you would have not covered under comprehensive is that you did not carry comprehensive. If you did not carry comprehensive, therefore it would still be a collision. So when we discuss which subcases that would happen where there is coverage under comprehensive and collision and not coverage under the specified cause of loss collision, we'll start with glass breakage. My question to you is, what caused the glass to break? If the glass broke because of a heat, and we know in Florida and other places it gets hot enough and we've seen glass crack because of heat, that would not be covered under specified cause of loss and collision, but is covered in comprehensive. But if a rock flew up and cracked the windshield, then that would be covered under specified cause of loss and collision because it's a collision with the rock, which is covered under collision. Same thing with hitting a bird, and same thing with falling object or missiles. Those are collisions with an item, and so therefore they would be covered. However, you can claim those under comprehensive. The reason you would claim it under comprehensive is because in the standard writing of a business auto policy, you will find in most cases that have a lesser deductible for comprehensive than you do for collision. In the commercial auto area for motor carriers, typically the deductible, there's the same amount of deductible for the comprehensive collision, but in the standard business auto writings, typically collision has a lower deductible, so the insured is able to claim it under comprehensive. The other things we have covered is something called where the actual tank implodes. This is where you have the fuel tank, or there's a tank on the back of the truck. Where you unload it, it develops a vacuum, causing the tank to collapse within itself. One of the weird cases I had defining this is when I had an insured who had a location in Tampa, Florida. And on one side of the location there was trees that bird nested in, and on the other side of their location there was a bunch of berry trees that the birds went over to eat the berries. And as they flew back across the insured's yard, they recycled the berries on top of their vehicles, and that was acid sitting on the vehicle because of the berries being recycled, burned the paint. That is covered under comprehensive collision. It would not be covered under specified cause of loss and collision. Again, because it's not excluded, it's covered, but it's not one of the named cause of losses in the specified cause of loss. One other thing that we've found is that where a driver actually died inside of a truck, again, that death causing, and it was there for 2 or 3 days, the inside of that cab now was in such a condition that could not be used and had to be completely cleaned. Again, that's the difference between the two. There's very little difference in a realistic standpoint when you have coverage with a $1,000 deductible. It is important in the smaller commercial auto usage that we would have for contractors and delivery and welding operations and things like that, because again, it's typical then to have lower deductibles under comprehensive than you have in collision. It gives the insured the option to do that. Another coverage provided is transportation expense. Again, private passenger vehicles only, very limited. $20 per day to a maximum of $600 for the temporary transportation expense. And this is when you're insured rents or borrows a truck from somebody else. After 48 hours after the theft, they can rent a vehicle after the theft after 48 hours to rent a vehicle until the policy expiration. But again, limited $20 a day with no more than $600. Very little enhancement for a business auto policy. You don't rent much of a vehicle for $20 a day, even or $600, and again, it's only private passenger. So loss of use expense. You can have hired auto physical damage. We will pay expenses for which an insured becomes legally obligated to pay for loss of use of the vehicle. This is to the rental companies, where when you rent the vehicle, we pay for the damage of the vehicle if you have hired car physical damage, and this pays to the rental company for the loss of the rental company use of that vehicle. Again, very limited, $20 a day and a maximum of $600. Here are the exclusions. Policy wording here. Nuclear hazard. If your insured gets too close to a nuclear accident, and that nuclear accident contaminates your truck, we do not cover that. We do not cover if you're insured if they use a truck in war, insurrection, rebellion, revolts, and other things. Again, neither one of those things are very apt to happen to vehicles that we're dealing with, but you have the cause of loss involved in the nuclear contamination, and you have the use of the vehicle in war. Both of those are typically in the marketplace because of demands from the reinsurance company, mainly because of Lloyd's. Lloyd's does not want to reinsure policies covering property without these two exclusions. So next one is racing. We will not pay for loss to any covered auto while using any professional organized racing or demolition contests or stunning activities, or while practicing for such contests or activities. We'll also not pay for loss of any covered auto while that covered auto is being prepared for such a contest or activities. We also exclude the liability for that vehicle involved in that, as well as the physical damage for those vehicles involved in that. So if you have insureds who are involved in racing at all, then you need to address that exposure under a different coverage form. Maybe even in marine coverage would be the best option here, where you specifically covered it. It would not be covered for liability and would not be covered for physical damage in our vehicles. Or excuse me, under the commercial auto policy. The next exclusion has to do with the cause of loss. We will not pay for loss due to and confined to wear and tear, freezing, mechanical, electrical breakdown, or blowout and puncture of any road damage to tires. This exclusion does not apply to such loss resulting from the total theft of a covered auto, just for the wear and tear and the blowout of tires. Those are the cause of losses exclusion. So we have two involved in the nuclear contamination and wear and tear and tires. And we have activities that are not covered, using the vehicle in war or in organized racing. By the way, organized racing is not somebody stopping at the stop sign betting they can get from point A to point B quicker. Organized racing is around a racetrack, around a drag strip, or things that's organized. We also don't cover certain property, tapes, records, discs, or other similar audio-visual or data electrical devices designed for use with audio-visual or data electrical equipment. We don't cover any device designed or used to detect speeding measurement equipment. This is your radar detectors. One part of this is because there's a lot of state laws that do not allow radar detectors to be in a vehicle. We do not cover electrical equipment without regard to whether its equipment is permanently installed that reproduces, receives, or transmits audio-visual data signals, or any accessories for such equipment like antennas, discs, and those things. Those are not covered here. That's types of property. Later we're going to talk about endorsement CE 9960 that you can buy back the electrical equipment and the apparatus to install it in the form itself. Those exclusions, though, do not apply to equipment designed to be operated solely by use of power from the auto electrical system, and at the time loss is permanently installed in or upon the covered auto, removed from a housing unit which is permanently installed or from the covered auto, or any integral part of such units housing electric equipment necessary for the normal operation of the covered auto or the monitoring of the covered auto's operating system. So that is the give back for that, and in a minute we'll find the policy carries $1,000 in it for this types of equipment. And again, if you need to buy any excess of this, the endorsement 9960 will allow you to buy in excess of the $1,000 in covered. This is important because as we move forward, there's going to be, for the larger units that our insurance might use, for the 18-wheelers, the ones that are operating under Federal Motor Carriers Administration's activities, they will have to have electronic logs on board, and this is the type of equipment that would fall under there. We will not pay for loss to covered auto or diminishing in value. This is a gray area. This is where if you have a vehicle that's damaged and now it's been repaired because of Carfaxes and the rest of this stuff, the vehicle itself has lost its market value, has lost its dollar value. So therefore we don't pay for that. All we pay is for the repair of the vehicle itself, put it back in the same place it was before the loss, not for the loss of value of the vehicle just because it was wrecked. So, recap, cause of loss exclusion. Following losses are not covered. Nuclear, damage by nuclear exposure. War, while the vehicle is being used in war. No coverage for covered auto for wear and tear or tire damage. We have activities exclusion, use in professional organized racing. And then we have types of property not covered, tape, CD, radar detector, electrical devices, not for sound producing, meaning the radio or the CD disc player is covered, but not others. The electrical accessory covered. It's limited to $1,000 permanently installed, or you can buy additional to that with CE 9960, as we talked about. Also doesn't cover phones, faxes, those things. Property not excluded, permanently installed electrical equipment, though it is limited to the $1,000. And there's no recovery for diminishing value. After repairs, the damaged auto could be worth less because of being in an accident. It's not covered under the first-party coverage under the policy. The reason I say here per policy, there were some court cases that came back, particularly a case in Georgia with Nationwide that required the physical damage carrier to pay that. Since then, ISO has added the covered or the wording in the policy that would not do not pay for those things, which in absence of state laws that would make you pay it, it would allow us not to pay it because of the contractual agreement. I'm not talking about third-party damage to someone else's vehicle, which clearly you have to figure that in the settlement of third-party damages. But the property damage in this form, the first-party damage, by contract, the insured agrees that they would not collect that loss of market because of the vehicle being wrecked or in a loss. All right, so we have covered auto, its equipment, and now we'll talk about the limits of coverage. The most we'll pay for a loss to any covered auto is the lesser of the actual cash value or damaged or stolen property as of the time of loss, for the cost of repairing or replacing the policy, replacing the stolen property with the property of like, kind, and quality. That's what the form says. It goes on to says, and again, all electrical equipment that reproduces, receives, or transmitting. That's the $1,000 limit that we put in here, and it talks about permanently installed, and the equipment must be permanently installed, and it must be in the covered auto, and the housing was designed to be covered in, removable from a permanent installed housing unit as described above, or an integral part of the such equipment as described above, and that could be the monitoring equipment in the engines for larger trucks, those items. That is limited to $1,000. An adjustment for depreciation and physical condition will be made in determining actual cash value in the event of a total loss. Again, and we do not pay for the betterment. That betterment is a concern that we have in some cases. For example, if the vehicle was damaged or stolen and there was tires on that vehicle that were half used up, we do not owe the insured new tires. We owe the insured half used up tires, which you cannot buy, so therefore the adjuster would take off of the settlement the value of the tires. Same thing if the engines need to be overhauled because they have a lot of hours on them, or if the paint job has been deteriorated and the repainting of the vehicle would cause it to be more valuable at that time because paint depreciates. We don't pay for those differences, so the insured, even though they're going to get settlement and the settlement will be paid less than deductible, they might not receive all the dollars there for things like tires, engine overhaul, and those kind of items. So limited coverage. What amount of dollars will be available to pay for damages? Valuation time of loss is ACV. What one just like the damaged auto is worth at time of loss. That includes the make, model, serial number, all of the equipment that is a part of the vehicle, as well as the condition of those vehicles. The cost new shown in the deck is not a consideration for recovery. The cost new, which is the standardized method of the premium, is just for premium basis only. Payment for damaged property will be what the covered auto and its equipment is worth at the time of loss. Same condition, same type, same equipment, which is the cost of repair or replacing with like, kind, and quality. Then you get the discussion we had a minute ago about betterments, tires, and engine. These items cannot be repaired but need to be replaced, so therefore the insured would suffer the difference between what it costs to replace those items and how much usable life was left in the units when they were damaged or when it was stolen. Also, you have a lot of discussion, there's a lot of advertisement on TVs about this, is that when items are being repaired, do you use items manufactured by the maker of the vehicle? Do you buy from Pet Boys or other items for aftermarket parts, or do you use used parts? Again, used parts would have to be repaired and repainted, but which one do you have to do? All we really owe is the used parts repaired or replaced, whatever it took in the same condition. This is more of a problem in personal vehicles than it is in the larger commercial vehicles, because in larger commercial vehicles there is a lot of time a ready supply of items that can be put on these units. Clearly, as a part of the settlement and a part of the adjustment, we owe that these parts are in fine condition, they fit properly, they have all the seals, they're not warped, they're repainted or repaired and bring it back to the condition. But you'll hear this discussion often in this, and we do not owe, in my opinion, the manufactured new part. We could use aftermarket parts. There's a lot of marketplaces for rechroming fenders and those items, but we also could use used parts as long as they are of the quality of the type of parts that was damaged on our insurance truck. This is a function of the value of the truck. One other thing about actual cash value, again, moving into the arena that a lot of y'all function in, and this is with 18-wheelers, part of the value is not in the year, but the useful life left in the vehicle, and it has to do with the miles. For you who are not familiar with this part of the marketplace, somewhere around 450,000 miles the cost of the unit doubles. For example, if the unit costs $50,000 and it is 4 to 4.5 years old, you could have as much differences in value of the unit as 10 or 15% based on, did we just overhaul the engine, or do we just have to overhaul the engine? So in the commercial arena, it's not only the age that determines the value for total losses, but it also can become the miles that are on the vehicle. The usable life of those components become a part of the valuation of the vehicle for ACV for total losses. Partial losses is where we're talking about here. What kind of parts do we replace it with? Used parts or aftermarket parts. The larger the vehicle, the more specialized the adjuster should be in adjusting those claims to satisfy both the insureds to get their vehicles back on the road as soon as possible, but to protect the insurer to pay what the policy requires them to pay, no more or no less. We dealt here with a standard ISO business auto physical damage coverage. It's based on original cost new. That's the premium base. The rate is a function of the age of the vehicle, 1 year, 2 to 3 years old, 3 to 4, or 6 or older, and the original cost new, grouped into brackets. Misunderstanding though, what is original cost new? It might not be what your insurer paid for it, because particularly if they bought it used. It's what the covered auto and all the equipment would have cost if purchased new, not when your insured paid for it. If your insured moves a fan body over or a utility body over from one to the other on the new truck, the original cost new would be what that new truck cost and what that equipment would have cost if they bought it new. That's original cost new. That's the concept of the physical damage coverage in the policy. By the way, the policy is auditable for that, meaning that if the adjuster comes back, or at the audit time, the auditor comes back and the audit time finds that that's misstated or understated, then the adjuster or the insurance company, the auditor, can make a premium adjustment. I had this happen one time where the vehicle got involved in the case where the vehicle was grossly under evaluated. The original cost new was shown in the $20,000 range. When the loss happened, the original cost new was $35,000. The adjuster says we only owe the $20,000. That's what's on the policy. No, they owed the $35,000 for what my insured, or what the individual that I was involved in the case for would have to pay the difference in premium. You owe it. Recovery has nothing to do with the original cost new. It's only a premium base. The insured receives ACV, what the unit's worth at time of loss, less the deductible. There's no capping of it. But the insured can say, I want a certain amount of coverage. I want to see a limit. I don't understand this original cost. I just bought this unit for $30,000. That's what I want insured for. They do not. Or they might have a bank or a leasing company that requires a limit in the policy. Or you might have an insurance carrier who specializes in large equipment that does not offer original cost new. In this program we're dealing here, the insurance carriers, again, for 18-wheelers, in most cases they provide physical damage coverage on only a stated amount basis, meaning a limit of the policy. Not the coverage in the standard business auto form where premium is based on original cost new. If coverage is a stated amount, premium based on the limit, either the specified carrier has changed their coverage form wording to state amount wording, or they add ISO stated amount endorsement C9928 is added. Then we convert the premium base and the settlement base from the original cost new, which the premium is based on the original cost new with no capping recovery, to stated amount, where the premium now is based on a function of the value of the item, 5%, 6%. And so this meets the insurer's request for cover for certain limits, meaning I show a limit of $30,000, I'm going to charge you premium based on that. However, recovery is not the limit. The limit is the premium base, and the most the insured can recover, not the guarantee of the recovery. Stated amount adds one other factor to the original cost new, but no more than the limit. So therefore, when an adjuster looks at it, they determine what is the ACV, what's the unit worth, what it's going to cost to repair or replace. Then if the premium base is original cost new, whatever that amount is, less the deductible is paid. But in stated amount, what happens is you adjust it exactly the same, you determine the damage is exactly the same, but now you either pay the damage or the limit, whichever is less. So therefore, stated amount never benefits the insured at loss time. It might be required by the carrier, it might be easier to understand, it might be what the insurer chooses, but it does not benefit them at loss time. The bottom line, standard ISO, premium base, original cost, new recovery, damage or worth, no cap. Specialty carriers, state amount. Premium base is the limit of insurance. Recover damage or worth, but no more than the limit. That's the big difference. Because original cost new has this policy wording. The most will pay for loss in any accident is the lesser of the actual cash value, the damage or stolen property at the time of loss, or the cost of repair and replace the damaged or stolen property with property of like kind and quality. When we look at the stated amount wording, notice it has exactly the same wording in it. A, the actual cash value, damage or stolen property at the time of loss, or the cost of repair and replacing the damaged or stolen property time of loss. But then it adds C, the limit shown in the schedule. So above it says the following will pay for loss to any loss is the least of the below. So therefore, we settle exactly the same, but then it's capped in stated amount. Premium based original cost new must determine what the cost of all items are, where if purchased new. Premium based on limit of coverage must make sure the limit reflects the current value of all covered items, meaning used value, the real market value. But neither method guarantees recovery. Could the insured owe more to the finance company or leasing company than the unit is worth? But coverage is for only what the unit is worth, not the limit or what is owed. ISO has developed an endorsement, gap endorsement, that will address the difference between what ACV is and what the financial obligation is in the case of a total loss. That's called gap coverage. Gap coverage has been available in specialty markets or with leasing companies for a long time. Excuse me. The endorsement CA 2071, auto loan and lease gap coverage. No guaranteed recovery amount from auto physical damage. That's why it's here. But by adding the gap coverage, CA 2071, the cover will be ACV or the limit, whichever is the most. So if the payoff amount is the limit or less than that, or less of the financial obligation, then at time of loss, we will pay what it's worth or pay the bank note off, whichever is less. Of course, again, less the deductible. So when this happens, the adjuster looks at it. It's a total loss, meaning that the unit itself, less the salvage, is worth less than the limit on the policy. It's a total loss. The adjuster then will pay what the unit's worth, or if you have the gap coverage, the CA 2071, and you have the limit properly high enough so it can pay off the obligation at the bank and or the leasing company, the adjuster will pay the bank or the leasing company off. The insurer really gets no benefit out of this because they don't get any of their equity back. They do get rid of an obligation. Clearly, if they had equity in it, there would not be a gap, but if they don't have a gap, so they have this concern. There is some things we don't pay for. We don't pay for rollover balances. We don't pay for late payments. We don't pay for late fees and those kind of things. So this coverage is more appropriate for newer units, high value, particularly when the insured can buy the unit with low down or lease it with low down payments. Very good coverage for newer units. I have a problem with some of the older units. I don't think it's quite as appropriate there. The insured doesn't understand that they might not get all the note paid off because on older units there could be rollover balances and late charges and those things, but clearly advantage for new units. So if your insureds have newer units and they're financing them or leasing them, this is some coverage that you would want to see that's added to the policy. Some specialty carriers build this in the wording of the policy. ISO allows you to add the endorsement. For each covered auto, we do deduct the deductibles. And so the deductibles are taken off either $100 or $500, 100 for comprehensive, 500 for collision, whatever it is. But the deductibles, if you have comprehensive, do not apply to fire and lightning. So physical damage, we cover the auto as equipment. Cause of loss, comprehensive collision, that's almost all risks. Cost new base of premium, base of settlement ACV, worth at the time of loss. We can write a stated amount where the premium is based on the limit, but the limit caps the recovery. It does not guarantee the recovery. We do have some general conditions in the policy that apply to all coverages. We still have to pay loss of bankruptcy. We can void policies for concealment, misrepresentation, and fraud if any of the facts were withheld by the insured, and we would not have issued this insurance policy. The liberalization says we have new forms. We'll interpret the old forms to meet the new forms, and there's no benefit to the bailee and the physical damage coverage, just to the insured. The other insurance is important in this, in that we cover the owned autos, coverage is primary, non-owned autos, the coverage is excess, and the trailers track the power units. Non-owned trailers attached to owned autos, coverage is primary. Owned trailers attached to non-owned autos, the coverage is excess. If we have hired car physical damage, though, under B, then that coverage is primary. So we have owned autos primary, non-owned autos excess, again, mainly for liability purposes here. And trailers track the power unit. But for physical damage, hired car physical damage, which would be available to cover your insurance obligations for vehicles they lease, hire, rent, or borrow in their possession. That would be adding Symbol 8 to hired car physical damage, as well as specified. That will then be a primary coverage. In this last few minutes, I want to talk about 4 endorsements: individual name insured, driver of the car coverage, and then auto med pay and UM. The key part of individual name insured and driver of the car coverage is their vehicles on the policies that are furnished to the insured employees, private passenger vehicles, and they do not have a private passenger vehicle policy. If your insurers, the user of the vehicles, have a private passenger vehicle policy, then this coverage that we're talking about is in the private passenger vehicle policy, not in this. So use of autos that are not covered autos for business purposes. Sometimes our autos owned or used by an insured, or owners of the insured, or insured's family or employees are listed and covered on the business auto form. I don't recommend it. I don't think we should do it, but it happens. When this happens, here's the exposure. Autos that are not covered autos. To be a covered auto, it must be owned, borrowed, rented, or leased by the insured, used by someone who is not an insured and not on insured's business. The example I use is that we have a vehicle that's furnished to our mechanic. The mechanic's vehicle has a trailer hitch on it. The mechanic has a right to use the vehicles for his personal or her personal use on weekends. We give him a new unit. The new unit now does not have the trailer hitch on it yet he wants to go out, or she wants to go out and use a boat on the weekend. They borrow the neighbor's boat to be used on the weekend. There's an accident, the vehicle to neighbor's vehicle to tow the boat on the weekend. There's an accident happened. Now the coverage that the employee would get for, or the person named in the coverage for that vehicle, use of that vehicle will be covered under the policy on that vehicle as a permissive user. But if there's no coverage, they would have no coverage on the commercial policy because it was not owned, borrowed, rented, or leased by the insured and being used for the insured. So it's personal use of vehicles. So it's activities involving use of non-covered autos for non-business use, personal activities for using non-covered auto. That's the personal auto policy. It responds. It's the best. That's where you want to provide coverage whenever possible. I would not provide this coverage to anybody, even consider it, except for the people who write a check for the policy. Then maybe we'll do it. Because if the person has an auto policy, then there's no problem. If not, then we need to cover this by endorsement. The 2 endorsement is individual name insured CA 9916. This is where the individual on the deck sheet is named, and that provides coverage for that individual and their family members, meaning spouses and children, for all the coverages purchased in the policy, which would include MedPay, and hired car physical damage. So if the insured has a private auto policy, then they don't need this. It's only if they don't have it. For corporations, LLCs, people who we do not name, this is the broad form DOC, driver of the car coverage, broad form CA 9912. When this is insured is other than the individual, corporation, LLC, partnership, it provides coverage by endorsement for personal use by named insured in that endorsement while using others' autos. Spouses are included, but children are not. You must list children. You have liability coverage, you have MedPay, and you have the hired car physical damage. But again, it does not cover family members. You need to list those coverages. Then we have MedPay. MedPay is C9903, and this is one of the things that frustrates me in this, and that's when I see MedPay covering on a policy covering only larger vehicle. Yes, it covers expenses incurred, necessary medical and funeral expenses caused by up to 3 years. It pays for family members, occupants of covered autos, but it doesn't pay for employees. So therefore, if the vehicles are only being used by employees, MedPay will not pay. And in the commercial arena that we mainly deal with, we don't want anybody in that vehicle that's not an employee. So therefore, MedPay would not pay. A private passenger vehicle policy, I understand that. Larger units, no. If I have a passenger in that vehicle, do I worry about them? Not for MedPay purposes. In fact, in the commercial arena, we don't want passengers in those vehicles. If our insured's liable, they would be covered under bodily injury and property damage. MedPay is so cheap because you cannot collect it. Again, I would recommend not having MedPay on the commercial policies. This last coverage we might also discuss in the same way, and that's uninsured or uninsured motorist. You must offer it. You must offer it and make it clear so the insured can make an intelligent decision to purchase it or not. That's Rule 1. Rule 2 is attempt not to provide coverage except for the amount required by the state. Most states allow rejection. Why? We're dealing again with commercial businesses, use of autos. The occupants in the vehicle should be an employee. The business's obligation to job-related injuries to employee is work comp. That's their only obligation. They have no other. So and IUM is not a required benefit to employees. Work comp is the sole obligation. If the employee's concerned with job-related injuries and their use of their employees' autos, they can purchase and uninsured motorist on their own personal auto policy. This is the same if we have non-employees in the vehicle. They can cover their own exposure for and IUM under the own personal auto policies. You must offer the option and have the insured make a business decision that's the best for their business. Suggested discussion. Insured, if your employee is injured in an auto accident while working for you, they will collect work comp benefit. This is your obligation to the employee for work-related injuries. If the injury is caused by a not-at-fault accident, your employee can collect work comp and also sue the not-at-fault party. Your work comp carrier would want to participate in this suit. If the party who injured your employee in the auto accident did not have liability coverage or not enough insurance on the auto that caused the accident to compensate the insured employee, you can purchase my customer can purchase uninsured or uninsured motorist on your business auto policy that will pay your employee for injuries caused by at-fault uninsured third parties. Your employee would collect on your auto policy as well as your work comp. So here's your decision. Do you want to pay premium for coverage you're not obligated to provide to your employee, thus increasing your costs? And if an accident happens and payment is made, the payment of the damage done by a third-party obligation will be reflected on your loss runs and possibly cost you additional premium in the future. Oh, by the way, your employee can purchase and IUM on their own personal auto policy that would pay them under their policy for the job-related injuries. So do you want to buy something here? Paying premium you do not have to might affect your losses for coverage that your employee can purchase. I'm not talking about the physical damage part of and IUM. I'm only talking about injuries to employees. I've used a form here as a part of the employment package for our insureds that spell out this works. The law requires us to carry work comp coverage to pay for damages to employees due to work-related injury. Your employer carries this insurance to meet their obligation to their employees. Your employer has elected not to cover uninsured motorists on its auto policy. The insurance is designed to pay for damage sustained by an auto accident caused by a not at fault uninsured motorist. Your employer has met their obligation to their employee in this instance by providing work comp coverage. If you feel you want protection beyond work comp, then you may purchase coverage on your own personal policy, and we have them sign this as part of the employment package. I've done this for 25 years and never had it come back upon us. Had a couple calls from lawyers, but once we produce this, then it pays. So folks, that's where we are. We already went the overview. You got to do the symbols. You got to make sure you watch the symbol 7. We got to understand the difference in mobile equipment or not. We got a liability coverage, covered bodily injury, property damage, direct coverage, and covered pollution cost and expense. The who's insured covers the owner, the permissive user, and the insured, but not the owners of the vehicles, not employees' owned vehicles, not the partners' owned vehicles. We have to add endorsements to cover those things. Exclusions to watch is contractual, work comp, care, custom control, the handling property as it relates to the general liability coverage, and the pollution. Physical damage, we cover the auto and equipment. Cost and use, the base of premium, base of settlement, ACV, worth at time, no limited coverage. And then the endorsements we talked about, the driver of the car coverage, and UM and uninsured. We did not talk about the buyback for the pollution, the CA 9948 that we talked about. I hope these 4 hours gave you an understanding of the business auto coverage. We look forward to your participation in future things. Take time to clear up the insurance needs, charge for the exposures, make sure the business auto and general liability are concurrent. Remember, there could be no coverage for certain exposures, and certain people might not be protected by the policy. You want to decide that up front. We thank you for your participation in this. We look forward to you continuing this for our next series starting in May, dealing with general liability. That will be for 4 hours of CE2. We're done.